Are you ready to explore the diverse world of business finance? This video delves into the various sources of finance available to businesses, both internal and external. Discover how these sources can fuel growth, sustain operations, and drive success. Internal sources come from within, while external sources involve outside entities. Each has unique benefits and drawbacks. Businesses require finance to start, grow, and sustain operations. The choice of finance source depends on size, stage, and purpose. Knowing these helps in making informed financial decisions. Each has unique benefits and drawbacks. Retained profits are previous earnings reinvested into the business. They don't require repayment or interest, preserving ownership control. However, they are only available if the business is profitable. Using them might limit dividend payouts. A manufacturing firm might use retained profits for new machinery. Owner's capital involves personal savings invested into the business. It's quick to access and shows commitment with no interest. Yet, it poses personal financial risk and is limited by the owner's resources. A sole trader might use savings to open a shop. This source reflects personal investment in the business. Selling assets generates cash without borrowing. It can reduce maintenance costs, but might mean losing valuable resources. This option is often a one-time solution. A business might sell an unused company car for marketing funds. It's a strategic move to free up capital quickly. Bank loans offer substantial capital with structured repayments. They require interest payments and possibly collateral. Approval can be strict, but they suit large investments. A restaurant chain might take a loan for refurbishment. This source provides a significant financial boost for expansion. 020300405. Overdrafts allow businesses to withdraw more than their balance. They're useful for short-term cash flow issues, with interest on the amount used. However, they have higher interest rates and are repayable on demand. A retailer might use an overdraft to cover supplier payments. This flexibility aids in managing cash flow. Trade credit lets businesses delay payments to suppliers. It improves cash flow without interest, but late payments can harm relationships. A wholesaler might agree to 60-day terms for stock. This source is advantageous for managing immediate cash needs. However, it requires careful relationship management. Leasing allows businesses to use assets without buying them outright. It spreads costs and might include maintenance, but can be more expensive long-term. A construction company might lease machinery. This source preserves cash while providing necessary equipment. Ownership remains with the lessor until final payments. Venture capital involves investors providing funds for equity. It offers large sums and business expertise, but means sharing ownership. A tech startup might receive venture capital for growth. This source is ideal for high-potential businesses seeking rapid expansion. However, it requires giving up some control. Government grants provide non-repayable funds for specific projects. They enhance credibility but come with strict conditions. A renewable energy firm might secure a grant for research. This source supports innovation and development without adding debt. However, the application process can be competitive. This source engages the public directly in the business's success. Debentures are long-term loans secured against assets. They provide fixed interest rates, offering cost certainty. Suitable for large-scale projects, they increase the debt burden. A corporation might issue debentures for expansion. This source is beneficial for stable, established companies seeking predictable funding. Businesses must align finance sources with their strategic goals. Understanding the purpose ensures effective financial management. This decision impacts overall business success. Cost considerations are crucial in selecting finance. Interest rates, fees, or equity loss must be evaluated. Businesses should weigh the financial implications of each source. Cost-effective solutions support sustainable growth. This analysis helps in maintaining financial health and profitability. Control over business decisions can be affected by finance choices. Retained profits maintain full control, while venture capital might dilute it. Owners must consider how much control they are willing to share. This factor is vital for businesses valuing independence. Balancing control with financial needs is key. Risk assessment is essential when choosing finance. Ability to meet repayment obligations must be considered. High-risk ventures might prefer equity-based finance. A thorough risk analysis supports informed decisions. This step ensures financial stability and minimizes potential setbacks. Aligning finance with business maturity ensures optimal growth. This strategic alignment is crucial for success. Using internal sources can enhance financial autonomy. This approach supports self-sufficiency and long-term sustainability. External finance provides substantial capital for growth. It often includes structured repayment plans, aiding budgeting. However, interest and collateral can be drawbacks. This source is vital for businesses needing large investments. It supports expansion and development, though careful management is needed. In conclusion, understanding business finance is essential for driving strategic growth. By carefully evaluating various funding sources, businesses can ensure their financial strategies align with their overall goals. Strong financial management not only fosters growth, but also supports long-term stability and success. Thank you for watching.